Hello to all traders. Apologies for any technical problems that we just had, but we are back. So welcome to another NFP engagement. So very excited this time around. We saw last time that the numbers, the consensus was roughly about 250,000. They came in at 528,000 new jobs hired. There was a little bit of a discrepancy because it was to do with the birth death rates in that respect. However, we are now seeing that we are looking to have another good showing on the NFP. It's supposedly to be a little bit less than before, but in this respect, it is still going to be in the positive territory. So a good jobs number for America at least. So because this is a live stream, please ask me any live questions you may have. We're going to be looking at the euro, the dollar index, gold, oil, anything you can think of, anything that's going to really move the markets for the NFP, and what has transpired and what is going to happen after as well. So we've got some viewers already. As I said, if you feel like asking any questions, please feel free to do so. And my colleague Daniel will also be joining me shortly to see what the opportunities are in that respect as well. So just bear with me a minute while I share my screen. And this will be giving us a glimpse into the NFP as well. So here we go then. So thank you once again for joining me. So I'll just go through a quick risk disclaimer before we get into the nitty-gritty stuff. So foreign exchange trading and investment in CFDs can be highly speculative and may result in losses as well as profits. Foreign exchange and derivatives trading is not suitable for many members of the public, and only risk capital should be applied. This webinar is provided for information purposes only, and no information contained herein constitutes a solicitation for the purpose or the purchase or sale of any commodity, security or investment, nor should it serve as the basis for any investment decision. Orbex Limited does not guarantee the accuracy or completeness of any information around supply. So without further ado, let's look at the previous readings that we saw, and it has been very interesting because we're looking now at analysts expect a slight decrease to 285,000. It did creep up to almost 300,000 previously, but 285,000 is still a very good number. And if we look back at what it potentially was, which was 300,000 in the last jobs reading, we are now seeing possibly another upturn in the US employment data. The unemployment percentage seems to be stale, a bit stagnant at 3.5%, which is something that remains pretty much key. I mean, it's been hovering around 3.6%, 3.5% for the majority of the time. And August NFP release, which was the last NFP, if we look on these stats here, we're seeing at the moment that we did get a big jobs number on 714,000, but then, as you can see, dramatically dropped lower, roughly about March and April time. It has been creeping back up slightly to roughly about 400,000. However, the last jobs reading was pretty phenomenal, up above 500,000 when it was supposed to be only 250,000. So what is in store this time around? Consensus is that we will take another dive to the downside, so indicating a slightly weaker dollar. But the dollar, which we'll look at the chart shortly, has been very, very positive, very strong recently. And also we are seeing what it has been in store for as well in that respect. So just moving on to the next slide. As I said, I'm not going to bore you with slides this time. We're going to get straight into the market shortly. We're going to see what are the potentials in the next few trading sessions as well. So US weekly jobless claims, they're still hovering above 200,000 per week, roughly down slightly from 250,000. So we haven't seen this 250,000 for a while, and it did creep up in the last couple of weeks. But from April, where we got below 200,000, it has been quite significant in that direction as well. Annual inflation, it's slowed down slightly from the record, or not record highs, 40-year high that we saw not so long ago at 9.1%. It's down to 8.5% in the last reading. Inflation has really taken its toll on the vast majority of the, well, let's say the landscape. This is a global event now as well. It's not really seeing that we are having that much of a impact. And in doing so, we are also seeing another move to the upside. And if that keeps happening, then we could see possibly another move a bit less likely. So something to think about as well. Just moving on to retail sales as well. They did stall in July, came in flat at 0, but expectations were just above that. But the main thing is it's in positive territory still. Well, it didn't slip into negative territory, sorry. It's still hanging on. But the main thing will be if we do get that negative reading that we did see at the back end of 2021, what would this mean for businesses in general? You know, retail sales is something that we have seen does have a lot of implementation in that respect. But saying that, we are now seeing what is going to happen in the next few trading sessions as well. ADP was back finally after a couple of months break, but the figures were down quite vastly. It's the smallest gain since 2021, and it will probably come in even smaller. For that, we're going to see what the main reasons are for the ADP coming in so small. You know, private jobs are very, very important for the retail section, for manufacturing, for any PMI data as well. So we're going to see how that's going to pan out as well. So just bear with me while we get a few things set up here. And I believe Daniel is ready to come online. So we'll just put on my magic headphones. Daniel, can you hear me?
I think so.
Okay, great, great.
I don't know why my camera is not on, though. That's the other thing.
No problem. We've got you a little bit, so it's not too bad.
Probably because I didn't press the right button. Okay,
there you are.
that seems
I can
to be
see
looking.
you now.
Yay. How's it going?
So yeah, great, Daniel. Thank you for joining me once again. So just talking to our viewers about retail sales and ADP as well.
Oh, right, yeah.
So in that respect, what are you looking for the next NFP? I mean, retail sales were flat, the last reading. ADP was quite low as well.
Yeah.
What would you say is looking for the next month of data for the American economy?
Oh, well, that's quite a lot because there's a lot coming out over the next month. But the thing about the ADP is that kind of everyone was a bit caught by surprise because it came out so low, and and also the ADP's been away for the last 2 months reviewing their methodology because I guess it's been a couple of years now that they haven't been able to accurately predict what was going to happen in the NFP. So presumably their new methodology now is to be more accurate. And so are they more accurate? And if so, is that telling us that we're going to have a kind of really disappointing NFP, or has their new methodology not really worked out? So there's still kind of a bit of a doubt out there. And then retail sales have been going down again because higher costs for borrowing money. The thing to point to really there is how much credit card debt has been going up in the United States. So if people are buying with credit cards and the interest rate on the credit cards is going up, that means they have less purchasing power, and that's something that we've been seeing with all the major companies, the Target and Walmart in particular. They're talking about how they've seen people no longer buying sort of more discretionary type things, like household appliances and clothes, and they're shifting over to buying food, which is of course a problem for those companies because they have the bigger margin. With the more discretionary stuff, and food has a much smaller margin, and that's why one of the reasons those companies had lower profits, and then that can translate to the rest of the economy. So I don't know if that I must have forgotten something along the way there. Sorry.
No, it's fine. I mean, I was going to say, Daniel, we've seen a little bit of a topsy-turvy way for the last NFP reading. It came in double over the expectancy, but as you said in one of your articles, it was to do with the birth death rate as well. So it was a little bit deceiving that all of a sudden we get such a high jobs number all of a sudden.
Yeah, it's a bit of I guess technical thing that most people don't really follow because there's a whole bunch of math behind it. But basically, it's a thing where the Bureau of Labor Statistics, it can't talk to all the companies, all there, so they take a sample, and so out of that sample, that's only a small portion of the total companies that are in the United States that are hiring people, and so then from that sample, there are going to be companies that go bankrupt for different reasons, and there are also going to be companies that are being created that aren't going to be in that sample. It'll be a while for them to show up in that sample. So then they have to adjust for it in a certain way. So that also comes down to a certain amount of assumptions. And so if you have a large adjustment, it's because they're assuming more companies have been created, or they're assuming that more companies have, or they saw more companies losing, or going bankrupt, or closing down business. So that's why the adjustment you can get these fluctuations month on month, but overall it ends up averaging out. So that might be because we had such a large adjustment last month. We'll have a much smaller adjustment this month, because again, they do this every 3 months to make the adjustment more accurate. And so the large one from last month is probably because they were updating the previous projection that they had for the prior 2 months, and so this one might be a little bit more in line, and so then we might not have such a large surprise. But I don't know the future yet. So
yeah, exactly. I have to wait and see the next 15 minutes. But with that being said, we've also got unemployment data as well coming in. It's appearing to be probably around the same, but it has kind of been hovering around this 3.5, 3.6% for quite some time, hasn't it? So is it a little bit deceiving as well to read in too much of the unemployment data?
Yeah, that's also another curiosity thing, because you keep creating these 300,000 jobs each month, and the unemployment rate is kind of stuck. So one of the things there is that the number of people that have second jobs and third jobs has been going up. So when the non-farm payrolls just counts the number of jobs, it doesn't count the number of people who have jobs. So that can be one of the phenomena where you can see the number of jobs increasing, but the unemployment rate staying steady. And the other thing is the unemployment rate could stay steady if more people are coming in. You have people getting jobs, and then more people are joining the labor force. But the other thing is that the labor force participation rate has been relatively stable as well. But again, the expectations here is that the unemployment rate is going to stay at 3.5%, but the participation rate is going to go up by 1 decimal. So that might be that there's 1 decimal percentage, which is how many? It'd be about 100,000. I forget the total amount, but
have you got your calculator at hand?
Yeah, I don't have it all memorized. The data changes each month, so it's kind of hard to memorize. But it's a certain number of people are going to be moving into getting jobs, and then they're joining the labor force. So the unemployment rate might be staying steady because there's a certain number of people joining the labor force who are the ones that are getting the jobs. And again, of course, the other thing is that we've had initial jobless claims rising. That's the number of people who are losing jobs, and then they are going on unemployment, because one of the phenomena that's been happening, or at least for the first half a year, is that a lot of people have been changing jobs because they want to get better pay. And so that's called the churn rate, which has been the highest it's ever been. Over 4 million people a month have been they quit one job to get another job. And so that also affects the dynamics, because then it doesn't change the total number of job creation, because presumably if you leave your job to go to another job, your company is going to hire someone else to replace you, presumably. Or maybe they don't, and then those high churn rate could be saying, well, we lost this guy and maybe we don't need to replace them, so then they don't, and that might mess with the numbers a little bit.
Of course. Yeah, it's true what you're saying. So I just want to jump on the charts quickly, because I'm sure you've probably been interested in the last few trading sessions that the euro dollar has hit parity once again, but instead of bouncing off and kind of seeing the euro dollar go to 105, 110, it's actually been hovering. It keeps testing this kind of region at the moment. Just currently we're just shy of parity at the moment, but with previous sessions, like in 2016, when we hit the 103 mark, or a few sessions ago where we did hit parity and we did see a bounce, there hasn't really been much of a bounce at the moment. The dollar is actually holding its own against the euro, would you say?
Yeah, that seems to be the thing. Well, actually, as we discussed last time, if I remember correctly, we were talking about how it's the differential with the interest rates, and one of the key things was going to be whether the ECB is going to raise rates more than expected. So now they're kind of pricing in about 50 basis points, maybe 75, and then for a period of time they're also pricing in less than 75 basis points for the Fed, and so that kind of balanced it out so that you could see the pair moving sideways.
Yeah.
But now the issue is that it seems very likely that the Fed is going to raise rates by 75 basis points, and it's
Yeah.
not as likely that the ECB will. So depending on what happens, because the ECB meets next Thursday, and so that will happen first, and then the Fed meets at the end of the month. So next Thursday we can see whether, if the ECB raises by only about 50 basis points, then maybe the euro will move down from parity and go further lower, or if they raise by 75, we might see that possible bounce off parity and then start moving a little bit higher, depending on then when the Fed comes along, they can go and switch it around again.
That's it. Yeah. But would you say the Fed has no choice now but to keep aggressively raising rates, just because it did say at the beginning of the year they've got, they're going to try and tame this inflation, but it seems it's the only plan they've got. They haven't really got a plan B, let's say, to try and tame inflation and get these basis points from jumping higher and higher all the time. I mean, it's going to be a triple header. I think it's going to be the third time in sequence. It's going to be 75 basis points if they do it again, isn't it?
Yeah, that seems to be the majority. I haven't checked the Fed tracker the last couple of days, but last time I checked, it was like there's a majority of people that are expecting at 75 basis points, particularly after what Paul said, and when you said that they're going to what they're going to be doing would be painful. It means that he's admitting basically that the thing that's most relevant, I guess, for the data that's coming out now is that basically the Fed is saying that they're leaving aside the unemployment issue. They're willing to accept a certain amount of unemployment because they have that dual mandate. They're willing to accept a certain amount of unemployment to get prices back down, because part of that has to do with the way, like the economic theory of Jerome Powell, because he's kind of a neo-Keynesianism, and so he really believes that what drives inflation expectations are, well, what drives inflation is inflation expectations, essentially. So if people think that the Fed isn't going to come out hard and bring the inflation down, then inflation is going to go up. So he really wants to communicate that inflation is going to go down. They're going to do everything necessary to get it to go down, and that is what will get it to go down, not so much necessarily the policy that they actually do. So that's probably why he's being more aggressive with the rhetoric. But then it seems like everyone's now pricing in the 75 basis points. So
there's some early rumors that, definitely from now. So
so if he doesn't deliver, then everybody's going to say, hey, wait a minute, you said you're going to go hard and now you're not.
Yeah,
exactly. You only do 50, so they're kind of pretty much boxed in. So I guess really it's the question of the pivot, whether it is going to be a pivot. And that's really what's driving it, that relationship between the 2-year and the 10-year yield, and the expectations of how long the Fed is going to be keeping rates up, and then that will be how much money people are going to be putting into dollar-denominated debt, which will keep the dollar strong. And so if they expect the Fed to start turning around soon, then I guess then we could start seeing the dollar get a little bit weaker, and then maybe the yen, the dollar yen will come down, and the euro might come back through parity and start going back up again, which doesn't personally benefit me all that much, since I get my transfers in dollars into euros, but I can't let that personal bias get in the way.
It'll be something you'll keep an eye on for sure, then, won't it? For that respect,
I'm very interested in where the dollar euro goes.
So would you say that's why the ECB hasn't really aggressively gone on this rate hikes? They delayed quite a lot, if you think of how much when the Fed started to when the ECB started. And also you got other central banks around the world that did delay slightly and haven't really aggressively gone for it, really, like the Fed. But like we said before, with Jackson Hole Symposium happening and all the FOMC minutes, all we've heard really is that they're going to keep aggressively raising rates. So would you say that other central banks around the world are maybe just seeing how it plays out in America before they go for it as well?
Yeah, that might be the thing for the that might be the thing for the Bank of England, because they started first, but then they've been only doing it by 25 basis points, 25, 25, 25, and then the Fed came in and did significantly more aggressively. So the Fed is sort of overtaken the BOE, and so now the BOE and the ECB and several others can see, well, what does the Fed do, and how does it impact? And then from
Yeah.
that they could adjust their policy a little bit better, which is a lot more convenient for them. And I think the ECB is a little bit more hesitant because they're worried about the potential of a recession, and particularly because of the fracturing problem that they have. Now they call it transfer risk. I think they keep changing the name for what the major issue is that the interest rates in some countries are different and the inflation rates are different in other countries. The Fed doesn't have that problem because, you know, each state has its own policy, their own laws and such, but they can come in and just, you know, pass the thing for everyone else. But in Europe, it's a little bit more fractured, and so that might be why the ECB will be a bit slower. But then going back to the BOE earlier, the British Chamber of Commerce came out and said that they basically see Britain is already in a recession as it is. And the BOE said that the recession is going to be starting soon, but they haven't said it's already here. So Britain hasn't had 2 quarters of negative growth yet to meet the sort of the technical definition, but that would be later. Like we would already, like the UK would already be in a recession, and you wouldn't know until the 2 quarters are up, and so we could be already in a recession.
Probably too little, too late in that respect then.
Yeah.
So Daniel, thanks for that. So just got a few minutes before the NFP comes into fruition. So I just wanted to, we checked the euro dollar chart, and for me, I'm looking at where this is on the daily chart, because I just wanted to see the progression of the dollar in the last, not only over the course of 2022, but even before that, even over the course of the last 12 months. And obviously we've hit parity now. We're hovering around that. So we're waiting for the next signal, basically, whether it's going to bounce off this 1-to-1 or if we're going to start pushing lower. What I've been tracking in the last few trading sessions is the movement of gold, because we saw this V-shaped collapse and a touch on the 1700 handle once again. Now, for me, I'm just waiting to see if we're going to, I'll just zoom in so it's a little bit easier to see, put it on the 4-hour chart. As you can see here, we've seen this bounce roughly just below the 1700 handle, and we're seeing a little bit of progression now. But gold is on quite a lot of traders' lips. We're getting a few questions about it live as we speak at the moment, where the next move is for gold. But, you know, obviously it is a case of where the dollar could be going as well for when gold and traders flock to safe haven and Bitcoin and these kind of things with gold. So where would you see gold for the rest of the year? Is it something we should be looking at quite progressively to move lower, or could there be another spring in its step? There
could be. I think it has the issue with gold right now has more to do with the inflation expectations, and that's why you get that large move, because sorry, at the beginning, it started there near the end of July, when people started getting a little bit more optimistic about stuff, and so you had the sort of the expectation that the Fed wouldn't be raising rates as hard, and so that's why you get the move higher, and then probably it turned around because people started. I don't know if that actually coincides directly. No, it doesn't. With the start of August, and that's when people started figuring, okay, actually the Fed is going to be hiking rates, so then you're going to have a stronger dollar. So it's kind of like more responding to the dollar than I guess the underlying issue things with gold. But then of course you have the mining problem because of all the droughts that they've been going on recently.
Of course,
To mine gold, you need a lot of water. So the big, but then the other thing is that China is the largest producer of gold, if I remember correctly. They're also the largest buyers of gold, and they've had a lot of, and so now China has a little bit of a complication problem because they have the droughts, which reduces production, but then they have the issue of their economic difficulties, which means people have less disposable income. So I don't know if that really washes out. So I guess I would be paying a lot of attention to inflation expectations to see.
Well, I was going to say, if you think of the beginning of August, when you said when people caught on that the Fed was still going to raise rates aggressively, we've had $1,000 drop in value in gold in just the course of a few weeks. So it is quite dramatic. Quite dramatic sell-off in gold in just like 3 or 4 weeks, isn't it? I mean, okay, we had the rise of $1,000 in just a few weeks, but gold is something that can be very volatile at the best of times. But during these times of uncertainty with the inflation, everything, is a lot of traders they're making some profits on it, aren't they?
Yeah, the more volatility you have, the better chance you have for making a profit, of course. But then, of course, you have to be paying close attention to the news and how the data is changing, particularly right now when you have such large inflation. So the inflation number, when gold is basically a hedge against inflation. So if you have moves in inflation, then gold price is largely going to move. So you have to really pay attention to that data. And right now, what's sort of second line is our retail sales, which you mentioned just as I was joining.
Exactly.
Yeah, because retail sales are one of the things that drive inflation. So you know, those two key data points would really help gold traders.
Exactly. So just looking at the numbers live coming in now, Daniel. So it says that non-farm payrolls coming at 315,000. So the consensus was roughly about 300,000. So not too much in the way. Like you said at the beginning of the webinar when you joined, there wasn't going to, we weren't expecting they're going to be a big surprise, let's say, like there was last time around. So in that respect, we are seeing a little bit more of a weak dollar now, with the euro dollar actually moving up roughly. Let's just see how many pips we've gone at from the start. So we've gone up roughly about 25 pips, nothing too crazy. But yeah, just touching on what you said when you first joined us, that there wasn't going to really be any big shocks like there was last month.
Yeah, it's definitely a little bit more common than what happened last time. So yeah, I'm gonna take a look, see if the birth death adjustment came out, to see if I'm right about that. Just guessing. Oh, the other thing there is the unemployment rate. You know, it jumped up to 3.7%, and the participation rate stayed. And you notice the participation rate went up 2 points. So it's really the inflation. The unemployment rate probably is a function of more people going to work, going out to get jobs, and that's why you get the move.
Exactly. So just for our viewers that are joining us now, so the non-farm payrolls did come in at 315,000, and the unemployment rate is up by slightly at 3.7% as well. We've got average hourly earnings slightly down at 0.3%. This is month on month. However, on year, it's roughly remaining the same at 5.2% as well. No big Canadian news at the moment because we get those NFPs where we have unemployment data for the Ludi. Exactly. So with that being said, with the dollar CAD, I'll just take a quick look on it, because I just want to see, I was just pointing out that again there was this significant like hummingbird scenario where we get a peak and then a bit of a lower peak and then a low, another peak, and then we're coming down in prices now. So with dollar CAD, Canadian dollar, it's always been a little bit precarious, especially with the oil creeping up as well. So could you just give us a little insight into where you see dollar CAD potentially moving in the next, well, we've only got 4 months until the end of the year. So until the end of the this year phases out.
Well, Canada has the distinct advantage because it's a smaller country, and so it can change quicker and adapt a little bit faster than a big country like the United States, and that's why you can get these stronger moves. But the thing about which is the thing that goes to for the Bank of Canada, that they can raise rates a lot more aggressively than the Fed can, precisely because they have the advantage of the oil exports. And so we're going into winter right now when there's increased demand, presumably. At the end of the year, then you have Europe's going to phase out buying oil from Russia. So you still probably continue to have a relatively high price in oil, which means a more income for the current account in Canada, and that would help keep the Canadian dollar a little bit stronger as opposed to other currencies. So of the different currencies that could appreciate against the dollar, even in a case of where you have relatively, I guess, a move towards safe haven flows, we could call it, because there's a little bit of uncertainty about the economy. One of the outperformers could be the Canadian dollar, because normally you think of the Canadian dollar as like a commodity currency, and but now it's kind of behaving in the opposite, basically, because oil is the unusual commodity at the moment.
Well, yeah, that's the thing. And also just touching on what you said about Europe officially cutting its ties with Russia by stopping oil imports by the end of the year completely. I mean, it's kind of been priced in already that Europe are going to struggle. The euro in general is going to struggle with the cost of living crisis. You've got gas supplies that are going to be a lot more expensive, oil supplies that are going to be a lot more expensive. Where do you see the euro being affected because of this cutoff with Russia? Do you see they'll get more production from America or OPEC countries and Saudi Arabia, or do you think it's the UK government or the European central banks haven't really thought of this plan B as they come into 2023 and obviously Russia cutting all ties with oil and gas?
Yeah, I kind of have an opinion that usually government politicians don't really think that far ahead.
Yeah, this is what I'm thinking as well. Yeah.
So I would give a little bit more credit to the European Central Bank that they probably thought of it, but that doesn't necessarily mean that the political administrators have thought of it, and so that could lead to a little bit of offset in policy. Usually the ECB and Brussels are a little bit at odds about what to do in terms of money.
Yeah.
But the thing is, with the euro cutting off supply from Russia, they're going to have to buy from more expensive suppliers, and they have been buying. You see the reserves in Germany are above expectations. That's precisely because they've been willing to spend a lot more money. And so that means euros are flowing out of the economy, and that means that they have to sell those euros, which puts downward pressure
Exactly.
on the euro. So
yeah.
the question is, are they going to? They're building inventories. They're supposed to have inventories up to at the start of November is when they're supposed to get most of their inventories already set up. So then they might stop buying at any price available, so that you might get a slower a reduction in outflows. But then, of course, it'd be winter. How bad is the winter going to be? Is it going to be a really cold winter?
Exactly.
And then that might also change the calculus there a little bit. So the trend is, until the energy situation is set up, the euro would probably also be further. That's another point pushing the euro down, and that's also probably another one of the reasons why the ECB would be more reluctant to raise rates, because if they raise rates, then that reduces the amount of capital that's available and makes it even more difficult for businesses to buy, because a lot of this is going to have to be financed by borrowing, and if you increase the cost of borrowing, then it's going to be more expensive, even more expensive for whoever's trying to buy reserves.
Exactly.
So
I mean, it's a bit of a vicious cycle at the moment, isn't it? I mean, it's and usually a very strong hot summer equates to a very long cold winter, because of obviously global warming is getting a little bit more apparent now, and obviously we've had these record droughts. It's something that you would probably think in other continents apart from Europe, but Europe has had one of its worst droughts in many years, so it is possibly looking for a very cold winter as well, so more energy bills, more heating bills, so that will be very detrimental as well. But obviously that's all to come in the next few months as well, and on obviously into 2023. So Daniel, thanks for your insight on that. Just want to quickly look on the charts at the moment, because we've had this 45 pip move on the euro dollar, which is kind of standard now for the NFP, but we're seeing a little bit more of a retracement. If we look at the full body of this candle, it's only really moved 20 pips, so nothing really to sink our teeth into there. Just want to have a quick look on cable, as we were just talking there. Again, I'll just put it on the daily chart and just zoom it out a little bit, because we haven't seen, well, I'll put it on the weekly chart actually, because we haven't seen these lows. We're going back quite a bit now. We haven't seen these lows since 2020, the start of the pandemic actually, in March of 2020. So we've seen this V-shaped collapse. Okay, it's taken a few years, but with cable, it's pretty much acting in consensus to the euro dollar as well, isn't it? We're having a bit of an upturn during the stopping of lockdowns and things being open a bit more in the UK and Europe. But in the last few trading sessions, Europe, because it is still connected to Britain, they are still going to have a cost of living crisis in the winter. It's still going to affect them with oil, heating, gas, etc. So would you say that the pound can follow the same route as the euro as we go into the last few months of the year?
Yeah, that would seem to be a pretty good analysis right there. I don't have all that much to add. I mean,
I try.
Yeah, I'd probably pretty much agree with most of that. The thing is, of course, is that Britain's going to have a new prime minister, so she might have sort of the initiative to do some changes that might
Yeah.
affect that a little bit. But I guess we won't know until Tuesday. I think that is
It's
when in
soon,
Canada.
yeah. I think the sooner the better, so that they can just get on with putting in their own policies and procedures, and then seeing where the pound could potentially go. It is looking like it will be Liz Truss, but you never know. Final, we've seen shocks before. Rishi Sunak was favoured for the role when Boris Johnson did resign. I think he was the favourite, but obviously she has come on leaps and bounds, and I believe she's the current foreign secretary. So we have seen other foreign secretaries in the past, Theresa May being one of them recently, that have come on and delivered what is quite a tough government at the moment. Nothing's easy as it was.
I wouldn't envy anyone who's in 10 Downing Street for the next 4 or 5 months at least.
Exactly, yeah. And there is that vote of the fact that if like Theresa May, she was voted in by her own constituents, like Liz Truss will be. There isn't actually a government referendum yet, so it'd be interesting to see when the government referendum does come into play, if Labour and Sir Keir Starmer has a good chance of being the next prime minister, because this is what happened with Theresa May as well. She wasn't actually voted in by the people; it was by her own constituents. So there will be that to play into account as well for cable. It could be quite a choppy road. So if anyone is trading on cable, they could look back on when Theresa May did hold a government referendum when she just narrowly won, and see what the markets did play out. That could give a good indication of how the markets could play out as well. So just a little touch on on the British pound, because obviously it's quite close to me, because I did study there and I am from there, obviously. So as you can tell by the accent. So Daniel, just lastly before you go, I just want to touch on gold one more time, because we have seen a bit of a spike now. But is this just, I mean, it's gone up roughly about $5, so nothing too significant for the NFP. But if we just put it back to the daily chart, as I said, from this $1,000 move to the upside and then back to the downside, is it possible we could see the 1800 handle again by the end of this month, or is it a little bit too? Is that a little bit too optimistic that gold will recover so much in such a short space of time? We have seen it at the moment, so it isn't beyond doubt. But will safe haven traders start flocking to gold if there's no advantage point for dollar?
Yeah, the other thing, of course, is the issue about the debate of whether or not the United States is going to be in a recession thing. So that would likely put some pressure on the Fed to either not raise as much or to not keep raising for as long, and that could help bring gold back. And then, of course, there could be a recovery in China finally, but then just now they put on new lockdowns in one of the third largest city, I think it was, or something like that, and so then that would reduce demand. But usually gold tends to perform better through October and November for several reasons. You have the wedding season in India, and then of course you have people buying ahead for the holidays as gifts. So there is there is fundamental reasons to push gold a little bit higher, but it will really depend on how strong the dollar gets, and how strong the dollar gets is going to be kind of bigger fluctuations, because inflation is so big, essentially. We're used to having inflation of around 2%, 1%, 2%, 3%, and now way up at 5%. You can get, a whole percentage point of inflation change in 1 month, and so that causes probably a lot more fluctuation. So, of course, higher volatility means more opportunities to jump in and trade, but then of course there's more chances that the trade could reverse. So probably pay close attention to the inflation rate, retail sales as mentioned, and then of course there's the tendency, like, I guess, raising tide that goes through to the end of the year, and also pay attention to the drought conditions in different countries. Chile, for example, they're having drought problems that have led to shutting down one of the processors, and of course their main focus, of course, is getting getting copper, but gold comes out with the copper. So there's also that's the other thing, is that because of all the the move towards green technology, they're going to be needing need significantly more copper, and most copper is discovered along with gold because they're in the same group of metals in the periodic table. So if there's going to be a lot more a lot more copper mining, then there might be more gold coming on that could put a downward pressure, but that won't be for several years. So in the shorter term, towards the end of the year, there is an upward bias, but you still have to be really careful about the inflation that's going on with the dollar. Of course, you know, we only had 1 month of inflation going down. It could pop right back up.
Of course,
you know, so you know, there still isn't a trend that we can really talk about it just yet, I would say.
Yeah, I was going to say, just touching on that, I guess the next major political starts will be the next Fed meeting on the 21st of September, I believe it is. And we'll be able, I mean, we won't talk about this until the next NFP, which will be the beginning of October. But would you say that's probably the biggest event of the month where we're going to be seeing the Fed come in? I mean, it is priced in, like you said, it is going to raise rates for sure, whether it's 50 basis points or 75 basis points. But we have a few weeks away, 21st of September. So would you say that we could see some dramatic moves on the dollar until that date? Or would you say a lot of traders have already priced in that the Fed are for sure going to raise their rates again?
I think there's more chance of volatility going I mean, the closer you get to it, the less chance there is for volatility, I would expect, because as people sort of narrow down their expectations. But one of the things there, even if they know pretty much how much the Fed is going to hike by, one of the things that could happen afterwards, which would give significantly more volatility, is Powell's speech and whether there's any kind of moderation in the rhetoric, and also the dot point. So it is a kind of, probably for the whole month, that would probably be the biggest risk event for any of the dollar pairs, and also for emerging markets, because again, the quantitative easing that the Fed has been doing previously had a lot of money flowing towards emerging markets, and now that's being pulled back through quantitative tightening, and so that can also have a secondary effect, something else to keep in mind.
Of course. Okay, Daniel, I think we've covered most of the markets, most of the major markets that do get a movement on the NFP. Thank you for your insight in that, and we'll just look forward to the next reading, which is on the first Friday of October. So we've got I believe it's the 7th of October, and also like we said, the next Fed meeting, which is on the 21st of September. So just a few things to keep an eye out for our viewers and traders of Orbex. So Daniel, thank you once again for joining me, and we'll speak again.
Thanks for bringing me on.
No problem, pleasure, and we'll speak again next time. Thanks again.
Take good care. Happy trading, everyone.
Thank you. Thanks a lot, Daniel. Bye for now.
Bye.
Bye. And for our viewers, thank you very much for joining me once again, and Daniel. It's been a pleasure to host this NFP, and what an exciting time it is for the markets. Okay, we didn't get much of a reaction because it was actually priced in that we weren't going to get such a big NFP reading, but it is actually looking very, very pleasing for a lot of the traders that we trade with at the moment. I had a lot of good questions about gold and oil and gas and the euro dollar for the next few months. So thank you very much for that. Thank you very much for joining us. Any questions, we'll be happy to get back to you with. And don't forget that our webinar series continues on Tuesday, where I host Trading Forex and the MT4 platform for beginners. This starts at 8 o'clock GMT time. So don't forget to join me then. Please subscribe to our YouTube channel as well for the latest in all the events. But like I said, don't forget to join me on Tuesday at 8 p.m. GMT for the first in a long line of webinars that I'll be hosting. Obviously, it'll be a live question and answers as well. Anything you need to know about the MT4 platform, anything you need to know about trading Forex or CFDs, I'll be at hand to help and guide and assist any questions that you may have. So that'll be very exciting as well. Very pleased to get back on the webinar scene as well. I had a lot of demand, so we bring you what you have requested. So thank you very much once again, and we'll speak again soon. Bye for now.